It's important to understand that not all credit scores use the same scoring model. Many financial institutions have apps where you can track your credit score. An example of this would be something like Credit Karma. And so it's important to know that your credit score that you're viewing on certain apps may not be the same credit score that we see when we pull a mortgage credit report, because not everybody uses the same formula. Credit scores typically range from 350 to 850. And different loan programs have different minimum credit score requirements. For example, a conventional loan has a minimum credit score of 620. And so this next chart illustrates perfectly what the credit score is really measuring. And so this shows the statistical chance of a person becoming 90 days late based on their credit score. So you can see that if a person has a score above 800, there's a 1 in over 1,000 chance they will default on their loan, which is very, very unlikely. But as the credit scores go down, the odds of becoming 90 days late go up. For example, if someone has a credit score of 660, there's a 1 in 38 chance that this person will become 90 days late. And so understanding this chart is important because it helps us understand why certain loan programs will have a higher interest rate or higher mortgage insurance cost for a lower credit score, because the higher chance of default needs to be compensated by a higher cost. There are 5 things that you can do in order to optimize your credit score. The first one has to do with your payment history. So you want to make sure all your payments are made within 30 days of the due date. Typically, you can actually go past your due date and it will not be reported to the credit bureaus unless you've hit that 30 days past. The second is utilization rate. You want to make sure you keep all your revolving credit, which is things like credit cards, make sure you keep your balances below 30% of your credit card limit, because the credit bureaus want to see you have all this credit available and you're only choosing to use a small portion of it. Next, length of history. You want to keep all your accounts open as long as possible. So even after a card's paid off, you want to keep it open. Types of credit. It's encouraged to have at least 3 different accounts at all times. If you're a college student viewing this video, this isn't really a reason to go finance a new car, just have an extra line. But if you're looking at optimizing your credit score, it's good to have multiple types of credit. And last, credit inquiries. You want to keep your information private. Multiple inquiries on your credit report, and an inquiry is when a hard credit report is pulled. It shows up on your credit report. You want to make sure that your credit is not pulled fraudulently or unnecessarily. And so you want to keep the inquiries to a minimum. And so I want to end with a pro tip for you. This is the quickest way you can raise your credit score before applying for a mortgage. And I've seen this boost a person's credit score 20 points, saving them over $200 a month on their payment. And we did this 30 days before they bought their house. Paying down your credit card balances to below 30% of the max available is typically the quickest way you can raise a credit score. So in this next section, we're going to talk about loan programs and how you can choose the right loan program for you.